Here's our opening price. I don't have a whole lot of expectation this morning. It's a little too smooth. ES is a bit of a mess. There's decoupling. Pretty expected actually when there's no news. See how they're going different directions? That makes it a lot harder for precision to be available to you. Doesn't mean you can't trade it, just means that you're trading with lower probability. All three of the averages should be moving together. I look for the S&P and the Dow to be moving in the same direction. If I'm wanting to be long, I want to see something that's supporting the idea for all three of them to be bullish. I'm watching this little gap right in here. I like the idea of that upper portion of that gap not being traded to. ES is making a lower low. Let's come out on a 15 on this. And Dow is just a mess. If it runs for the sell side, it's just going to be one of those instances where first presented fair value gap doesn't give you an entry. Remind yourself that it's decoupling. It means there's the mixed direction on all three averages. Dow doing its own thing. I'm watching this volume imbalance. The question probably comes up in your mind is, okay, if you're noticing now that indices are doing different things, one indice going one direction, the other's doing the other direction, where's the actionable ideas on that? You have a choice. You can sit and wait for the indices during the morning session to either come together in terms of agreement or they start moving in tandem. Sometimes that happens in the same session. Sometimes it takes the morning session to sort all that out and over the lunch hours. Then the afternoon becomes a little bit better to trade. Or the worst case scenario, it can stay decoupled all day and make very problematic conditions for trading. Unless you're really, really short term and you're just taking the smallest of things to do that, which I'm not a fan of it. Let's take a quick look at Dow once more. I would not want to trade that. The ES, NASDAQ still looks okay. We've been weak. We did not get a return back into first presented fair value gap. We have bearish order block, trades up into here. Notice the bodies inside this gap. The bodies stay right at consequent encroachment or lower, where the wicks are allowed to do that type of damage. And then we roll back down, rotation out of the volume imbalance. Even with the decoupling, I would like to still see that sell side deliver. But then because it's mixed, I would like to see some kind of return back into the range. Let's see how we see it trade down into sell side. Explore a little bit lower than that, and then if it can make its way back up in here, and if the NASDAQ shrugs off any weakness as well, back up into here, going into the second half of the AM session, that would be something I would look for. One of the best things you can do is give yourself permission early on is to let trades pan out when it's highly unlikely for precision to be there. So we can still see elements to the things I teach, but these are the types of little things that'll probably mess you up. Even though it's done this, it's not a high probability trade. That means that these are the types of setups or movements and price action that I'm comfortable sitting on the sideline and just watching them, not being a participant in it. These types of scenarios happen all the time. The very, very choice setups for you to get in, they're not as frequent as these. Quick look at the Dow once more. See, look at that. So it's going the other direction. And then ES, let's take a quick look at that. No real expansion on the downside, but it still has its sell side. Volume imbalance right in here. And back into NQ. As you can see, anemic opening range gap. Again, first fair value gap forms actually in that same area as well. So we have taken sell side on a mixed decoupled AM session. Now, two scenarios on a morning like this where the averages are doing different things. Dow's going up, NASDAQ best performer on the downside. ES that is moved a little bit, but it hasn't quite made the same type of delivery for its sell side down here yet. Like I want to see if it fails to go lower. If it does that, it's going to run for the buy side here and maybe explore the orders up in that area there. That's where the buy side would be, these two highs, with this one being lower than this one. And you see these really clean little, almost too perfect, isn't it? If it fails to go below the sell side, NASDAQ tries to come back up into its range. That would be where my eye would go to for ES, but it's conditional. We'd still have to work out the uncertainty of this sell side being taken or not in agreement with the NASDAQ returning back up into its range. That would indicate that this could potentially become an inversion of fair value gap, and that may support a run back up into first percent fair value gap and back into the opening range gap, which is kind of sharing the same price range. So we have the settlement price here, and then we can go back out to electronic trading hours. Two frames of reference in here. We have the first presented fair value gap that never got traded to yet. The consolation prize was that we could see this fair value gap forming here. And the bodies were laid down and buried right at the consequent encroachment of that. And the wicks were permitted to do the damage. This is just simply returning back into these two candles. Because they're two consecutive up close candles, you use the opening price of the lowest. That's your order block or change in a state of delivery. You see it going right there. The Dow. Again, being a brat, ES. See, we've already hit it there. Watch the consequent encroachment of this wick. See, I hit that right there. And in a perfect world, it would roll out of this and go down and attack its sell side liquidity. See how it's very, very difficult to frame any kind of stop loss in all this if you're trying to be short. There are going to be times where you're not being afforded a very low risk entry or an entry at all, despite knowing where it might still trade to. Some neat little turn back up into the opening price there. Hammered it perfectly. There's nothing in here to frame an entry on. So the only thing we're really watching and observing is, does it have the ability to rotate out of this and attack the sell side, which is the only thing that makes sense down here. Doesn't mean that it can't go higher. It just means that if it does, who cares? It means it doesn't have the highest degree of probability. And as an educator, I'm trying to teach you to focus on those circumstances. It's not just simply, let's throw anything at the wall and see what sticks as a short. And then you wonder why you're getting chopped up, losing real money. It's because you're forcing things in conditions faster than you should. You're taking a leap of faith when it doesn't warrant that. Whereas if you had a lot of things going in your favor where all the indices were moving in the same direction, we traded back to the first presented fair value gap and then it showed displacement after that. Then it's easy. We could drop down to a 15-second chart and take the very next fair value gap and trade, in that direction. I'm looking at this little gap right here. Yeah, should be rolling over. Really ugly. I'd like to see if it can come back up into the range here. It's done enough exploring for me. If it wants to go back up in here, I would like to see it come back and trade back into the opening range gap. Would not want to short it. Would not be interested in chasing it lower. S&P is shrugging off any willingness to want to go lower. So look at the low here and then look at the NASDAQ. Lower. In NASDAQ, we wanted to see the NASDAQ lead to the downside. The S&P has not been wanting to go lower. And you can already see how it's showing its willingness to want to go higher now and not go lower. Focus in here and over here. And then the minor one is here. And the Dow still wanting to do what it wants to do. I think we're a little too far extended to want to come back into this. I mean, it can, but I wouldn't demand it. And now this one right in here, running an inversion fair value gap. If we were to trade back into the range after breaking out below to the sell side, we've seen so far. Now, sell side resides here. What I would rather see is Dow either stays going higher or consolidates and allows ES to hold its ground, not break below this low. Notice this wick that I was drawing on, this consequent encroachment. Stopped it here, traded back above it, and then the bodies, consequent encroachment of this wick, and then the low of that candlestick right there. And then this volume imbalance, we traded through it, and look what happened right here. The body stopped on that high of that volume imbalance, and it stopped on the body right there at the open and started rallying. And it went down into it, but didn't breach it. See that? Back into this fair value gap, but the liquidity rests here. So it doesn't make any sense for it to come all the way up here just to get to that. It's already shown it's not wanting to go to its own sell side down there. You're going to want to listen to this again, even though it's not an exciting lecture. It's teaching you visibility through this chaotic decoupling between the three averages doing all different things. I'm pulling out the things that are salient, what would be catalysts for the market to see it back into its range. The S&P would shake off any weakness. That means it sets the stage for what? SMT divergence, which it was not willing to make lower lows here when the NASDAQ was able to make lower lows. And now we're trading up into this gap here. It can accumulate in here and run right out of that. That's one of the caveats to an inversion fair value gap. If a market's extremely strong and you're expecting it to perform like I've outlined here before we even move back up into it, I said once we hit sell side, it fails to drop down, which is what we've seen so far, then this could become an inversion fair value gap. And then we watched the NASDAQ create lower low, but then the ES failed to make a lower low at the same time that the NASDAQ did that lower low, at the same time that the Dow just keeps going higher. So the way these indices come back into agreement and become symmetrical is Dow stays consolidated, don't lose any ground, don't go lower, or keep going higher, and then ES fails to make a lower low, and that's what we've seen so far. NASDAQ makes the lower low and then comes back into its range and uses this as an inversion fair value gap. Now, the caveat is it can just leave this thing and never come back down and touch it and use it as a discount array. So that's why sometimes if I'm really convicted on the idea that I think the market's going to go higher in this instance, I'd be taking the trade as it's hitting this candlestick's high right there. We're trading right at this point now because it's in consequent encroachment. In instances where it's really bullish, it affords me to get my first 6 contracts on, and I may not get my 4 contracts if it comes back down and touches the high of the gap. So that's why many times if you look at my examples, I'm entering inside of an inversion fair value gap before it actually proves itself to you as my students. When I know I'm bullish, I'll just enter inside of the inversion fair value gap as it touches the candle that enters it, which is here. We saw that there. And I said, or I'll just go in at the consequent encroachment and look at the bodies of the candles right there. You see that? And then we've already delivered here. These are the kind of lectures that I wish someone was teaching when I was coming up, because that would have really helped me slow down and I would have not hurt myself as much as I did because I was in a rush to try to make money and quit my job and get out of poverty, basically. All right, let's take a quick look at the Dow once more. And ES, and it runs to the buy side here. I'd like to see it go up here and smoke those highs right there. And back to NASDAQ. See how we just keep gaining ground and we never came back into inversion fair value gap? If you're extremely bullish and what you've already outlined or anticipate as an inversion fair value gap, if you're really, really bullish, why would you wait for it to come away from it and then come back down? If you really want to get out there and boogie and get down, then get out there and get down. So if I know I'm bullish, once we enter this area in here, I already have the conviction that I want to see it, use it as an inversion fair value gap. Why would I give up the opportunity to take an entry at a very low price inside that inversion fair value gap or at the midpoint of this gap? And you can see the body's delivering on that right there. And that to me is a signature that I try to press upon you as my students to say, what's the chances of that happening where the bodies close and open on the second candle occur right at the midpoint? You know, these are things that I keep teaching you to look for. I'm watching this little gap right here, that little gap right there. So I'm watching, does it want to just spike into this and then try to continue on, or does it want to use this order block right here? I'm waiting to see if it can get up in the first presented fair value gap. This is a profitable study so far because we're working in a problematic condition. So we're back inside that order block I was mentioning right here. Still could come right back down in and hit that inversion fair value gap. It's not out of the realm of possibilities. It still can do that because there's a little gap in here. If I could see that stay open, that would fuel a run higher than the first presented fair value gap and the gap closure. And then it's even here, back to this buy side there. And despite everything that's been outlined here, I have absolutely zero interest in being in the marketplace. Couple that with visibility, knowing what I'm looking for, still being able to anticipate what is likely to happen in price on a 1 minute chart. The first thing you have to learn is capital preservation, knowing how you're going to lose money, in what type of market environment you're going to lose money. And if you can't recognize that, you're not going to recognize the increased difficulty in you applying the things that work in good markets, because the complexity of having a market decoupled and you trying to be demanding of precision elements that may elude you because you're trying to run in mud. So you have to be a little bit more reserved and say, okay, I'm not trying to force a trade, but I am going to watch price action and see if these things that are being outlined are helpful. Did you see the ES not want to go down to its lows here? It showed an unwillingness to do that. And it would run for the buy side here, and it would run over here. We have the market making that lower low in NASDAQ, as I indicated, would likely do after it took its initial sell side. Remember, it was a little bit higher up here. It went down below it, and then I wanted to see it trade back into its range if ES failed to make a lower low. I forecasted a SMT divergence before it happened. I told you that we would see it return back into its range and come back up into the first presented fair value gap. And we're back inside the opening range as well. What I would like to see it do is power on higher up and punish those that are short, that have their stop loss sitting right there. And if they're going to run that high, then it's reasonable to anticipate that. The main takeaway is this. I know what my algorithm is going to do. Time to put the bullshit aside. It's mine. When I talk to you, I'm talking to you as its coder. If I'm not allowed to sit at the table, I'm going to make more of me. And I tell you, an inversion fair value gap that was going to form here, it may not come back down and touch it. And you're looking for it to come back down and trade there. I'm telling you, I'm going to enter it right there as it touches the candlestick's high. And if I don't get that price, I'm going to get the consequent encroachment. And then it runs away. Does it ever come back down and touch that? No. I told you I wanted this fair value gap to stay open because that would be a breakaway gap. It leaves this PD array, and if it's breaking away, it's not going to come back down. It could have done that. And then I would say that would be an entry point right there. But I said I would prefer it to stay open. And I told you I wanted to see it trade back up into the opening range gap, which are these two blue lines here. But more specifically, I want to see it trade back to my first presented fair value gap. There's a lot of things that you're going to be met with on days like this. And you're going to expect to see certain things pan out if you don't recognize the decoupling. And the decoupling, again, is the unwillingness for all three averages to move in the same direction. So here's the NASDAQ chart, and then we're going to put the Dow here. So here is the ES. Here is Dow. We've seen at 9 o'clock this morning, the ES, it drops down. 9 o'clock in the morning here, we have a little bit of movement lower, and then the Dow says, oh, absolutely not, and starts going higher. At the same time, the S&P was going lower. And at the same time, the NASDAQ dropping down. In all this mess here, because there is no symmetry, meaning that the Dow was going one direction, S&P was going lower, and NASDAQ was going lower. That's fine. How can I still read the NASDAQ like I did? Because I had the coupling that still existed directionally with the ES. I don't care so much about the Dow. The Dow tells me I'm in a decoupled state. That means I'm going to lose a lot of precision. That means I'm going to lose a lot of resolution in visibility of reading price action in my NASDAQ. And I'm definitely going to have a lot of resolution issues in the ES. It's going to cause like a fuzzy, out of focus picture. Even though I can see it's likely to keep going down, and I told you, I want to see ES failing to go lower. If it fails to go down, take its sell side. That's what I want to see. That means if I'm expecting the NASDAQ to go lower, it's going to create an SMT divergence. That means it's going to fail to make a lower low on ES when the NASDAQ does make a lower low. And then the NASDAQ will go up back into its range and trade back to its first presented fair value gap. When you see decoupling, and generally you're going to see the Dow become that little brat. That's its usefulness to me. I don't care that if the Dow makes a lower low and the S&P fails to make a lower low. I don't see that as a divergence. To me, it's not SMT, because I know that the 30 stocks that make up the Dow are not that impactful overall, but they will normally bend to the will of both the averages when ES and NASDAQ are going lower. All boats rise in high tide and they all drop in low tide. That's the analogy here. When it's really, really moving, the Dow should be moving in sympathy with the ES and NASDAQ. But if in the morning session we open up and it starts doing like it did this morning, that means I already know that I'm going to have visibility issues with the precision. That means that we're decoupled. So at some point later on in the session, there's going to be a SMT divergence and they're going to go back in sync. The Dow is simply telling me, no, we're not going down there right now. So I'm going to be looking for the S&P because this one's going to be fuzzy compared to the obvious imbalances and stuff that we saw over here that I annotated, and you can see the prices reacting off of. We're seeing a lot of overlapping in here. Every candlestick, the range keeps overlapping with the previous one. There's a lot of revisiting of the same prices. So this is like fuzzy type of price action compared to, see how much more nice and refined every little range. We were able to see the bearish fair value gap here, changing the state of liquidity, bang, hits it. The body stayed inside the volume imbalance here. We have a volume imbalance here. The body starts in there and leaves it, doesn't come back up into it. That's weakness, drops down. I told you this is going to be an inversion fair value gap, but I also said it may not even come back down and touch it. And I told you I want to see that fair value gap stay open. That would be a breakaway gap, and it would take us right back up into, what is this? Oh, look at the bodies here respecting the first presented fair value gap. The volume imbalance that I annotated over here, because this is all part of what? Market maker buy model. Does the market maker buy model have to come back up and clear out the original consolidation? No, but you have to know where it's going to draw to, and you were told that. The volume imbalance here, it trades above it, comes back down, a little tiny little bit outside of it, comes right to the top of it, and then sends it right into the promised land, the first presented fair value gap. There's a whole lot of corruption everywhere. The markets are absolutely rigged, and they're doing a lot of things right now in the last 3 years they've never done before. They've never done these types of wild whipsaw, but then get right back in the sync again. There's a whole lot of hand involvement in this. When you can sit out in front of a chart and you can see what it's going to do and you're not swayed, feeling impulsive that I have to get in this trade because I feel like I'm going to be right and I need that itch scratched. I need to feel good about something. When you're no longer replacing lack of happiness, if you're not looking for your trades to reward or fill in that place in your life and you're consistently able to see what price is going to do, when you're not being swayed from outward influences, me, anyone else online, but you can still see what price is going to do and you know how to enter it and where your stop would be, and you have no emotional stimuli around the outcome of it. That is the surest way to know that you're ready for trading with real money. Because if you trade any time prior to that, I promise you, you started too soon and you're probably going to blow your account, or you're going to have a whole lot of drawdown, and then you're going to create scar tissue, and that makes it so much harder to do it with real money. You got to be able to say no a lot more than saying yes to a trade. There has to be more instances where you'll say as an analyst and trader, no, I'm not interested. Even though you can sit there and say it's most likely not going to go here, but it's going to go here. But no, I'm not entering that trade. But someone that says no frequently and says yes to high probability conditions and setups, that's a person that's going to have a long career. It's going to have longevity. It's going to be consistently profitable. They're going to have losing trades, but their losing trades are not going to cause them to tail spin and go into full tilt and blow their account. So you think that I'm taking thousands of trades in a month. I'm not doing that. I'm looking for the ones that are just the easy, slow ride in with no adversities. It's low resistance liquidity runs, no friction. It's just a slide on in. There it is. Thank you.